Good morning and good afternoon, everyone. My name is Patrick and join my partner Ethan. We're from Leaside High School and we'll be talking about stock and video. Our recommendation is buy. The current price is $191 at February 1st, 2026, and the target price is $536, which is equivalent to 228% growth. NVIDIA is no longer just a chip maker. It is a pioneer of accelerated computing and the backbone of the global AI infrastructure. Founded in 1993, the company has undergone a massive transformation from transforming PC gaming with GPUs to defining the modern data center. Currently, as the largest company in the world, it has approximately 85 to 94% of the market share in both AI and gaming sector. But NVIDIA's true competitive edge isn't just silicon, it's a full stack ecosystem. By integrating world-class hardware with the CUDA software platform and high-speed networking, NVIDIA has created a seamless environment that is now the industry standard for AI development.
Our investment thesis on NVIDIA is built on four key foundations. First, AI demand is not periodic, it is structural growth. Second, NVIDIA isn't just selling chips, it controls a complete AI ecosystem. So CUDA, networking technologies, software, and system-level integration, NVIDIA has built high switching cost advantages that make its platform difficult to replace. Third, NVIDIA translates its ecosystem advantage into economics of scale through execution advantage that it compound at scale. Finally, the structural effectively limits downside risks. Management and governance are also key factors in our positive outlook for NVIDIA. First, NVIDIA shows outstanding capital management by investing in core technologies. Second, founder-led governance supports long-term strategic execution without short-term market pressure. Finally, NVIDIA's engineering culture is institutionalized across the entire organization.
On this slide, we frame the industry setup behind NVIDIA. First, hyperscaler are in clear AI capex surge. Microsoft, Alphabet, Amazon, and Meta are all stepping up spending and growing share of that budget is going directly into AI data center, compute, networking, and power infrastructure. Second, compute intensity scales non-linearly. As models get larger and workload move from experimentation to production, the requirement compute doesn't grow linearly, it accelerates. That's why demand is shifting from buying chips to building cluster level system. Third, AI is becoming a core infrastructure. Similar to electricity and cloud, is not a short product cycle. It's a foundational layer that enterprises government will keep investing in. On this chart, it clearly reflects NVIDIA's market performance since 2021. NVIDIA has not just outperformed its peers, it has effectively decoupled on the broader market. While S&P 500 and QQQ show steady growth with gaining 79.2%, 88.4%, and its biggest competitor AMD having 169.5% growth, NVIDIA has delivered a staggering 1,298% return, dwarfing competitors like AMD. This isn't just momentum, it is the market pricing and NVIDIA's shift from a component seller to a platform monopoly. Despite this massive run, our analysis suggests that because NVIDIA captures a disproportionate share of every dollar spent on AI capex, the risk-reward profile remains favorable as we look towards 2030. NVIDIA's competitive position, we compare to Intel, Broadcom, AMD at scale, valuation, and capital efficiency. NVIDIA leads clearly in scale with a market of approximately $4.25 trillion, reflecting a central role in AI infrastructure rather than a traditional chip cycles. From a valuation perspective, NVIDIA trades around 45 times PE, which is lower than Intel, comparable to Broadcom, suggesting its premium is not excessive relative to peers. The key differentiator is capital efficiency. NVIDIA ROIC of nearly 97% significantly exceeds Broadcom, AMD, highlighting its asset-light, platform-driven business model. NVIDIA's competitive advantage is structural, not cyclical. First, CUDA creates high switching costs. Once model workflow and engineers are trained on CUDA, switching hardware becomes economically and operationally expensive. Second, NVIDIA delivers a full stack AI system, not standalone chips. From compute and networking to software and deployment, NVIDIA controls the entire AI factory pipeline. Finally, NVIDIA operates as a platform provider. Customers don't just buy GPUs, they build AI factories on NVIDIA ecosystem, reinforcing long-term lock-in and pricing lower.
Revenue drivers. This graph shows NVIDIA's total revenue by fiscal quarter. We could see a steady growth start from 2024. There's three main reasons that why it's happened. First, NVIDIA generates profit across the entire AI system. As customers expand their AI workloads, they will purchase the copy system that include hardware, networking, and software. This drive higher revenue per development rather than just the growth in sales per unit. Second, as system complexity increases, NVIDIA's value capture grows non-linearly. As models scale up and the infrastructure becomes more complex, customers become more reliant on NVIDIA's integrated platforms. Finally, software and system level integration reinforce this model. Forecast, Forecasted earning. From this graph, we could say NVIDIA's data center business has seen explosive growth. This reflects the previously mentioned per cluster billing model. Also, this growth did not come at the expenses of profit margin. Consequently, NVIDIA's profit growth significantly outperforms than traditional semiconductor peers and its competitor. Valuation. Our valuation framework focuses on risk symmetry. The bear case scenario assumes both AI spending and valuation multiples revert to normal levels, capping downside potential at a reasonable range around $320. The base case reflects a more normalized growth environment. AI infrastructure demand remains strong but gradually slows, implying a valuation of approximately $530. The bull case scenario captures platform dominance and system-level revenue potential, extending upside potential to about $900.
There are four key risks we closely monitor. First, AI infrastructure spending can be volatile. Hyperscaler capital expenditure is inherently cyclical, and short-term pauses in deployment could impact near-term revenue growth. Second, customer concentration and internal accelerator pose a risk. Large cloud providers may attempt to develop in-house chips and potentially reducing external GPU purchase over time. Third, NVIDIA faced execution risk in fast-moving technology cycles. Maintaining leadership requires flawless execution across hardware, software, and system integration as architectures evolve rapidly. Finally, geopolitical and regulatory constraints may affect supply chains, addressable market, particularly through export controls.
ESG, the demand for AI is experiencing structural growth, and the total energy consumption will rise regardless of the supplier. Therefore, the relevant ESG issue is not whether energy is consumed, but how energy efficiency can be improved. This chart shows the performance per watt of leading machine learning hardware. We observe that energy efficiency is improving consistently at a rate of approximately 1.4 times per year. NVIDIA's leading accelerators consistently remain at the forefront of energy efficiency. This means identical AI workloads can be achieved using less servers, lower energy consumption, and fewer carbon emission. From an investment perspective, this is crucial because energy efficiency directly translates into lower operating cost, greater regulatory reliances, and long-term infrastructure sustainability. In terms of governance, NVIDIA's long-term capital discipline ensures that the efficiency gains are reinvested into its core platform rather than short-term expansion. Thanks for listening, and more valuation model will be on the financial report. Here's the references.